Hello, everyone. I'm Steve Ankerstar, the founder and CEO of Ankerstar Wealth. And tonight I would like to present to you the Investment Advisory Board for Q2 of 2022. So we're going to take a look at what happened in Q1. We're going to look at what happened at what I project to happen in Q2, and then give you an economic forecast of what I think for the rest of the year, next 2 to 3 years, and then of course for the remainder of the decade. So as a reminder, as we're set up here, it is a webinar style, so you're not on camera. The only way to communicate with you can communicate with each other through the chat window. If you want to throw some stuff out there or some ideas or BS flags or that was awesome or whatever, I do not monitor the chat, so I'm not looking at it at all. If you do want to ask a question, which I will take at the end, go ahead and put it in the Q&A window. So again, not a normal format for Zoom that a lot of folks are used to. It's a webinar format. So questions and Q&A, whatever you guys talk about in the chat is up to you. I would like to announce we have a new member of our investment advisory board. We recently added Michael Gultz, who's an investor as well as now an advisory board member. So welcome, Michael. Looking forward to talking investing with you and hearing what you have to offer and being part of the team going forward. Standard disclosure applies for any time you give an investment presentation. So this is solely me, even though it's an advisory board, I'm the one that's officially approving what goes out on behalf of the company. So everything ties back to me and my personal projections on what I think is going to happen in the market and how I'm investing your money out there. This is releasable to the public. You can, it's going to hang on YouTube. You can send it to your friends or whoever if you want to refer them. But it's basically an open moment of I'm telling you what the top 10 holdings are, the investment philosophy, what the themes I think we need to put our capital behind going forward, and what are some of the high risk opportunities that are out there. I will cover some of the home runs and some of the strikeouts from Q1, so owning both the wins and losses. And then at the end, I'm going to talk a little bit about some operational efficiencies. As you know, Ankerstar Wealth is in growth mode. We are adding people. We're up to now 6 people on our team, and it's only going to grow that much faster. So part of my responsibility now is to bring people on board that can take tasks off of my plate onto theirs. So it frees me up to do 2 things, which first of all, make money with your money, because that's our primary mission. And then secondly, be able to grow the business along the way. So here's the standard presentation. And of course, the last paragraph there are several forward-looking statements. I do not have a crystal ball, nor do I profess to ever have a crystal ball, but I will say it's always advanced application of probabilities. So we're looking at things that will probably work and then allocating capital as we see fit. Okay. Here's the background of the company for new investors that have not heard this before. Did grow from basically scratch from $1.5 million when I was able to talk Scottrade into letting me in the door as an investment manager to the team we have today managing 52 million in assets. And I'll tell you, that was as of a few days ago. It's even more now. So the big thing that really to take away from this slide is the rapid response to client concerns. That's up top. That is the promise. That is the mission. If you have a question, you need to ask it. Primarily email is the best, and we're going to get back to you within 24 hours. Through operational efficiencies down the road, I hope to be able to do even faster response than that. And again, rarely it'll be me unless you actually need my level of expertise. I do have a junior advisor on board now who can handle, a certain level of questions. If it gets more complex than that, then he'll reach out to me to weigh in, and we'll go from there. But certainly the team gets smarter and more experienced on a daily basis. And with that all leads to us better serving you as the end client. Okay, here are the numbers. If you don't like the numbers, I will try to be fast and get back to the words. But for those that do like numbers, you should love this chart. So you can see there on one side, 52.5 million in the book. This was as of the last day of March. The first quarter of 22 was obviously a roller coaster. So congrats for most everybody held on. I did lose a couple along the way that really didn't like what they saw. And fortunately, emotions can get the better of you in trying times. That's why a lot of people use advisors. I will say that the compliments that I've received during this quarter from more than one client was my portfolio was surprisingly resilient in January and February during that big downturn. Now I will tell you, there's probably at least 10 people laughing that are mostly in, tech heavy portfolios that are saying, Steve, mine wasn't. Well, if you're heavy into tech did hit a bear market. So obviously the results may vary. But if you have a diversified portfolio and up into the 7 figures or so, generally you're not taking full market risk at that point in time. You're building in that resilience, and I've had some very happy folks. So maybe you didn't even look. Maybe you looked at it 100 times a day. That's all your choice. But overall, very pleased with surviving that downturn in January and February, cutting loose as the things that didn't work, and then loading up on the things that are going to work or we project to work going forward. Overall, assets under management, 85%. AUA is 401ks, thrift savings plan, alternative investments. Alternatives is their own category there, but those sorts of things that I don't actively manage, can only manage through having the individuals contact me and then me giving them advice from there. For the standard investments, you'll see we're up to 315 positions. Here's how that works when you say, Steve can't remember 315 positions and obviously can't track all of them. I'll agree with you. I'm not trying to. What I have on my radar scope are the Ankerstar Wealth core holdings. And there's about 20 that almost everybody gets in some fashion. And it goes out to about 50 or so, depending on your risk level or conservative level. There's some things that would not be in a higher risk portfolio. So on a daily basis, that's the core group, is that 20 to 50 that I'm watching closely on a daily basis. The other stuff, if you are in Under Armour, Intel, that I've inherited that, or you put yourself in that, that's fine. I want you to be excited and confident in your investments. However, with that, I put some generic limits on it, and you're generally not going to see me make a recommendation on your holding that you brought in, unless something really crazy happens. So a lot of times you'll hear me say, that's fine. That means, okay, sure, it goes into the book. So as you can tell, if you subtract 50 from 315, there's a lot of that. Pardon me. But that's okay. It's in there. It shows up on all my screens and alerts and everything. And if something crazy would happen, good or bad, I'll make recommendations on it. You can see the rest of it below. Probably to highlight, there's really an increase in the usage of ETFs lately, with 2022 turning out to be a volatile year. A lot more of exposure to thematic ETFs instead of individual stocks, if you will, just to reduce some of that volatility. When you talk theory of investing, you can talk, let's completely diversify, spread it all out. Something always goes up when something else is going down. Well, you saw in 2020 that didn't care what you held, it all went down. 2022 in January was the same way. Everything was selling off. However, how do I like to invest for folks? Again, focus that portfolio, really get behind themes that are out there to change the world and best of breed companies, tie all that together, package it with accordance with your risk tolerance. And that's what we're seeking to do here, to get as much performance as we can out of that particular set of securities. Off to the far side there, alternative investments. Most of these, you have to be an accredited investor. In other words, $1 million net worth outside of your portfolio, and or make $200,000 a year as an individual, $300,000 as a couple. So if those sort of things interest you, I can sit down and talk to you, but we have to sign contracts for that stuff. So it's a little more time intensive, but I will tell you, BCred is one of the best investments out there. Just bar none for the exact environment that we're in right now. So let's talk about that a little bit more. Here are the top 10 holdings. You can see there's 12 up there because 2 fell off the list. And I always want to talk about things that are not performing as well. So overall top holding, Apple, can't say enough, best company in the world. It snapped back. If you were staring at Apple, which I get it, I get paid to, you don't. But if you were anyway, just because it's fun, some of us, you saw Apple completely snap back. It had 11 days in a row where it was straight up. And obviously, as the #1 holding in the book, personally and in the book, you can tell that obviously that made a huge difference in that portfolio snapping back significantly, even when some of the other tech names didn't. Amazon obviously increased 1 position there. That's what that +1 means. Green is good, meaning it's moving higher. Red is bad, meaning it's going down. But obviously, if it's on this board, it's good overall, just not relative to where it was from the previous quarter. Amazon's got a 20-for-1 stock split coming up this summer. Skip down to #4. So does Google. So we've been loading up on Amazon and Google. They're at high price points, right around that 33,000 to 3,300 levels. So it's kind of hard to buy a whole bunch of shares without it taking over your portfolio. But certainly, if you have this in your portfolio, that's wise. We're going to go for that 20-to-1 stock split. And people ask me almost every day. So that means we're going to sell as soon as the split happens. And I can say emphatically, no, we are not selling when the stock split happens, because that's when the party begins. If you want to look at stock splits, you can do this on your own time, or I'll do it in the morning brief one of these days. Look at, literally it's tapping the keg at the party, because that's when things get fun, is the stock starts screaming higher. Look at Tesla when it did its split. It's rumored to be, talking about another one. Apple, when it's done, it's a kabillion splits along the way. Yeah. Oh no, we're not leaving anytime soon. Now, if you're buying a house and you need a down payment, or there's reasons to sell, or if they take off and it starts taking over your portfolio, I'll need to trim some of it. But no, we're holding those. You can count on that. Okay, number 3, KDUX. It's a mutual fund. What? Right? I say I don't like mutual funds, and this one has an expense ratio over 1%. So why would the guy who probably talked to me way back when put me in a mutual fund with over 1% expense ratio? The answer is it's worth it. This pays out a 6%. It pays out monthly, 6% distribution. That is, it's a credit fund, so it just clips along like clockwork. It is boring, and the money just hits the account. They keep over their percent because they get paid to do all this, to make they make that 7.5% and give us 6%. There are certain people out there I talk to that are so against the fees that they will, cut off their nose to spite their face, if you will. They do a lot of hard work to make sure our money's secure, and they can pay out that 6%. So they get it. Not very pleased with them. First Trust, RDVY, you can see in number 5 and number 7 there, both are DVY. Those are index funds that are on dividend achievers. So when we talk about, they're both new, been loading up on both of them to try and reduce volatility. And we'll talk more about how 2022 is going to continue to be volatile. It's not over by any means. Anytime you get in a rising interest rate environment, volatility is through the roof. Dividend payers, by their very nature, they're not necessarily safer, but they certainly reduce volatility. So that's what I'm looking to do here. You have the rising dividend achievers, and then I'm missing a letter there. I mistyped it. It says mid cap rising dividend. It's actually SMID cap. That's not a word. I got it, but that's what they mean for small and mid cap. So you have your big dividend, achievers, and then you have your next 2 levels down. Really, I think that's where the alpha is. The small and medium companies have been kind of crushed. But if they're strong enough to pay a dividend, that means I'm willing to back them with our capital, that they will not be crushed and eliminated during the Great Resignation, during inflation, during Fed rate hikes, that they're strong enough to be able to outperform. So that's why we're in it. Cybersecurity hanging in there at number 6. I've been a believer in that well before the election, well before Ukraine, Russia kicked off. It's going to be a problem, and cyber is the solution. Hacking is the problem, cyber is the solution. I don't care who gets better, the mouse or the mousetrap. Both are going to make a lot of money in the future as everything becomes electronic. So we want to have money behind that theme. The next one down there below the mid cap dividend is the PPTY. We got into that early in anticipation of inflation, and we've been rewarded handsomely. I am wondering how much higher that fund can continue. So it will probably be on the decrease either this quarter or the following quarter. I would expect to see that fall out. And the next one, BCRED. How can you tell me that BCRED's the best out there and then have it fall 2 spots down on your down on your list? Well, a lot of that is because I'm so moving to safety, or reducing volatility is a better description of it, in other accounts that can't get into BCRED, that those positions are just moving higher on the aggregate than BCRED. So again, BCRED, you have to be able, you have to qualify, you have to be able to sign a subscription agreement. You lock your money in really for a year or pay a penalty to get it out. People don't want any part of that if you're not what I would call a savvy investor, if you will. So it's not for everybody. I'm not even talking about this to a lot of folks, because they would be like, what? And they take a 2% fee too. It's like, what? I'm paying 2% for these people. Yeah, you are, because they're they collect 10% and pay us 8%. So it's paying 8% like clockwork. It's a fantastic deal. I have a significant amount of money in it of my own. It's my favorite investment, not top because I still have all those Apple shares. But I really like it. And Blackstone, of course, is the best out there. I'm not apologetic at all for being a fanboy of Blackstone and pretty much everything they do. All right, the last one there that's still the number 10, robot artificial intelligence. That's going somewhere. Elon Musk talks about it every day. So definitely want our exposure to that. The two that fell off the list, fixed income has, if you remember back 3 months ago, I said we're going to shift to fixed income. It has been slaughtered more than I could have even imagined. I knew interest rates were rising, so why would I shift to fixed income? I was like, well, it'll sell off a little bit, stabilize, and then start a march higher. No, it jumped off the cliff on me. So having to liquidate a lot of these for folks. Some were holding through. So if you still have in your portfolio, that just means, okay, I'm gritting my teeth, taking the punches to the face, and come out the other side, right? If I'm still here, but it's there's a lot of accounts that were heavy into these positions and they sold off. Now, when the market sells off 20%, these sell off like 2%. But when you think you're not taking any risk, I understand 2% could be a significant move, especially if this was, house money or, money that was not supposed to ever lose anything. So, and the last one, the fixed opportunity income fund, same thing. It only pays 3.5. So it got hurt more than some of the higher yield stuff we have out there. HYSL is one of them that we have, and FPEI. Those pay a little bit more and they've held up a little bit more. But those are off the list. They may still be in your portfolio, but that's one of the couple of places where if I need new money for something, I'm going for. Okay, investment themes. The shift towards reduced volatility. Last quarter was shift towards the fixed income. That was a strikeout. And now it is a shift towards reduced volatility with the dividend players that we already talked about up top. Credit and secured lending. If you don't want in BCRED, you can get into BXSL, which is another kind of the same, but it floats on the open market. So, you still have some of that volatility. And then on into preferred securities, which we never talk about. But I'm in a fund that kind of handles that for us, and that pays pretty well. Bright red there, Metaverse, Facebook, now Meta, and Unity Software and Roblox, they all were terrible. Just complete house of pain, complete strikeouts. I love the long-term theme. It failed miserably. We've largely had to bail out of most of those. Only the most seasoned or grittiest investors that have true belief are still left in those names. Of the three I mentioned, I still like Roblox best, but they had another negative headline this week where the CEO took a big pay package, and it's that's just greed. That's just Wall Street greed. I don't like it. Cybersecurity, we talked about, it's done great. Real estate, great. Artificial intelligence, great. Data management over in the right-hand column. I still like info's the new oil. You heard me say that about a year ago. It's true. Information's where it's at. So all of the data, cloud computing, all of that stuff still plays. Financials have a little bit of risk, right? Rising interest rate environment, financials should go up. However, you heard Jamie Dimon a couple of days ago say that the increased bleed over risk from the Russia-Ukraine sanctions, it's going to have an effect on the U.S. financial system. So he's obviously the longest seasoned in the chair financial CEO out there. He was in the chair at JP Morgan through the financial crisis. So that's spooky stuff to hear him say that. There's going to be a time to move in. Don't know if it's yet. We'll see. National defense has paid off handsomely in exposure to Lockheed Martin, Raytheon, Boeing. Obviously, the sad part of, it's the good side of obviously the tragedy that's going on in Ukraine. But money's flowing into defense stocks, of course. Stuff that did not work, augmented virtual reality, that was mostly through Meta, all that's on hold. Payment processors, we were into firm holdings, did not work, drop like a rock. I will say cryptocurrencies and veteran coffee did. We'll talk about BlackRock here in a second, but crypto, if one thing that I think the sanctions of, we're sanctioning Russia, well, nobody sanctions crypto. So it's I think there's a lot of attractiveness from, you have inflation and money printing in the US, and people are like, maybe I should move into crypto. You have, Russian people saying we're getting sanctioned. Maybe we should take our money out of the ruble. And if that's correct, then move it into crypto. I don't know. I don't know the end of the story, but I do know it's going higher right now. And it may end up at zero. I still can't rule that out. but man, it gets more legitimate every day. I mean, again, I don't have direct exposure, but I have indirect exposure. If you're interested, ask me. Veteran Coffee's Black Rifle Coffee Company. We were in it at $10. It was a SPAC, a special purpose acquisition company. We're still in it now. I mean, the market, you saw what the market did today, right? Okay, if you didn't, don't look or don't listen for a second. But yeah, the market sells off, a couple percent today. Black Rifle Coffee now up at $26.64. It was at 10, 4 weeks ago or something like that. And yeah, it was up 10.5% today while the market's down. It's kind of on its own trajectory. If you've seen me sell some of it for you, it's because we're taking profits. It's already gone up, over the 100%, now at 150%. I think it goes north of 30. We'll see. No crystal ball. Okay. China. A lot of you have said, I don't want any exposure to China. I'm telling you, China's dirt cheap. If you're in the business to make money, I think there's going to be a time to load up in China. I generally talk to the individuals before I start loading up, but I'm back into Alibaba. It's too cheap. So let's talk if you want it. If you don't call me. What didn't work? Any of the marijuana names, even though we're supposed to vote again on legalizing, that has been a house of pain. It's been a train wreck, complete strikeouts, and then nothing moving forward with the man-machine technology. No real advances there as far as money that we can put behind it. So overall for the forecast, obviously the quarter in review, January and February were harsh, right? Kind of like December 2018 in that, the market sold off just super quick, right? And it was kind of straight down and hit technology harder than anything else. Obviously, when you think of big themes for 2022, you have to talk inflation. Okay, that's the disease. You have to talk the Fed with the rate hikes and the taper tantrum with the bond, their balance sheet. That's the cure. And we don't know which is worse. And the fear is the cure is going to be worse than the disease and kick us into recession. I'm not on board with that yet, but I can see a scenario where that happens. And then the last one's the Russia-Ukraine conflict. My personal take, I said at the beginning when it kicked off that it would be done in like 6 or 7 weeks like it was in 2014. We're at that point. We're just now into like week 7. So unless it wraps up real quick, I'm going to be wrong, but I think it's still going to be measured in weeks and not months. But obviously if we're still worrying about this well into next year, that's going to be a huge headwind. January and February were hit hard, and then the March retracement was that snapback I always talk about. When I say, the roller coaster, so the time to get off the coaster is at that 5 to 8% down sort of thing. Those are where all the decisions are made. That's sleepy time for most advisors, I think, or individual investors. It's like, probably won't get worse, probably won't get worse. Keeps getting worse. Now you get to that 20% off and they're just like, crap, I should have made a decision 2 weeks ago. And I would say, yeah, I agree with you. So you have to make the decisions early, and you get rid of you get rid of stuff that you don't want to hold through. But if you're going to hold your Apple shares through or BCRED through, you don't care, right? At that point, once it goes, you just stop selling, and then you start, take the sell hat off and wait for the buying hat on while your portfolio is bleeding. But that's how you invest. That's how you buy low and sell high. So tech hit a bear market, so 20% off. That was a complete sale on tech names, and a lot of them come back significantly. Okay, ahead, what am I calling for the next quarter? I'm not in the business of trying to predict short-term stuff, but I will say, here's the things that I think happen. We still have significant volatility. Inflation's not going away. The rate hikes will happen either on the schedule or more aggressively. I put in bold there. I would not have thought this 6 weeks ago, but now I can't see. I think the Fed has taken so much heat for not addressing the problem seriously enough that they are now going to do a 0.5 point rate hike. And that's going to spook everything again. January is very clear. Chairman Jerome Powell said, hey, we're going to do a 0.25 point. We're going to do it 7 times this year. And, and here we go. And that's, if you add all those up, that's 1.75 by December. And everybody's like, all right. And then after that whopping 0.25% raise, what happened to inflation? I mean, you noticed, right? What happened to inflation in the last 6 weeks? It didn't stop, didn't slow down at all, right? I mean, completely unaffected. So that's a problem. And of course, gas is kind of separate and stealing the headlines, but no, inflation it's like honey badger, like didn't care. So I think we're going to have this 0.5 point rate hike, and that's going to cause a lot of drama. Other stuff out there, I do think Secure 2.0 passes. If you're below 60, you probably don't care. But it's dealing with some required minimum distribution stuff. So there's some different things out there, but I also do And that auto corrected there. No significant tax reform, not six tax, but six tag. What? That's backwards. Anyway, that's crazy. No significant tax reform is what that's supposed to mean. So all that scary stuff that was going to come out, it's not coming out. They may pass that billionaires tax that affects, way up there. Yeah, it's not going to affect the market. All right, for the remainder of this year, I think we will do what we did in 2018. We will overshoot on rate hikes. The Fed will be like, I want to do this nice and slow. And then they do, and it's not working. So what do? My favorite leadership phrase from the Air Force was, why simply react when you have the time and energy to overreact? So you see it all the time. People want to make moves just for making moves. And you'll see them like all of a sudden ramp up the interest rates, and they'll do it too fast. And the market, could take a significant hit. We could have, that negative GDP quarter, which that's the first step to the recession, right? So I think we overshoot. There's going to be a whole bunch of political posturing going into the midterm elections. So you won't be able to tell what's true in the world and what's not. And then we'll have contentious elections. I do think we'll see a significant increase in red seats from the election. That's just what I think. And the economists I listen to, that's what they predict as well. And then 23, I think 22 could stay ugly the whole time. But after that, I think after we have the overshoot, that's when we're on a road to health again. Interest rates may not go all the way back to zero, but it will stop being raised. I think we'll at least flatline or maybe even decelerate a little bit. And then the economy after the election, I think, takes off again. So we'll see. But yeah, that's what I'm calling. What didn't I mention anywhere on this chart? COVID. We're done. I know there's lockdowns in China going on, but I really think US is done as far as affecting the economy. We all know what we need to do to stay safe and healthy. We have beat that dead horse. But locking the doors and locking us in our houses, I don't think we'll see that again. Okay, for a decade, it's kind of that way too early or way too early forecast or whatever. I would just say mentally, you need to prepare. If you've been thinking back your whole life going, you know what, I'm going to get 20% year over year. I go, yeah, that was exactly what you got in history, right? I mean, that's what we've been getting for a decade since the global financial crisis. It's going to be back more normalized. I think 10 to 12%, you work your butt off, you get 10 to 12% of the return. And I think you have to slap a high five and go from there. I'd like to tell you that we're going to see the 20%. And if you are, it's going to be in technology. So that's where our focus is. But we shall see. I do think the big firms, it's kind of like when you think of the, people say, the wealth inequality in the US. And I agree. I see it. I agree. They're not wrong. The same thing happens in the market with the big companies get bigger and it gets harder for the smaller companies to break in, right? So that over time, everything's saying about, the class system in the US or unintentional class system, right? But yeah, those are the forces is where you see that difference. And I think, companies like Apple, Google, Amazon, you may know that I'm a fan, are going to continue to grow, and they're going to grow out of control. And they're going to, I would assume they would break up on their own versus being forced into a breakup by the US government. Because, that's probably not the perfect group of people to come in and chop up your business. But yeah, I don't think it can continue. So anyhow, just like way back when with AT&T splitting up or Ma Bell or, when things split up, the value of the pieces is generally more than the value of the whole. So not only am I happy that or projecting that's going to happen, I'm happy it's going to happen. I want it to happen, honestly. Amazon, you could break off Amazon Prime, the video from web services from people delivering stuff to my door, or the other 20 things that Amazon does, right? That I probably don't even know about. I think all that could break up and stand on its own. So that's what I anticipate for the next decade. So more of a normalized stock market versus the 20% a year. Okay. Let's get on to what I know some of you are waiting for. So there's a lot of stuff on this slide. The new share price is over to the right. I won't even try to sugarcoat it. We had a fantastic March. When you look at, the new share price, 118.09, that's a move up from 110.93. Literally for those that, obviously I can't talk about it. But folks were asking, and I put out the investment brief not long ago, to say, hey, if you want to become an investor in Ankerstar Wealth, here's the share price. And, I've been very vocal and open about the formula. If you ever see, 2 months in a row. The AUM is on the left-hand side of that. So when you see, December, we closed the year at 49.3. We were over 50 for a while, but it didn't hold. And it doesn't matter. That's all artificial, right? Did manage to grow in January as a business. We still grew even though the market was going straight down. And then, again in February, we were able to grow even though the market was going down. So a lot of new money coming in from current and new investors and, buying low, right? So it's like, find your extra money. Let's go buy into these names while they're low. And then when the market snaps back, we're up at 52.5 now. So obviously huge move up in the stock price there. We aren't going to get into the formula, but if you're an investor, congrats. That's I did the math. I thought I did. There you go. Went up $7.13 a share. Yeah, I lost the math. I don't know, 6-7% or whatever. I did have some. I signed the last contract at 7:13 for a 7:30 start tonight. And again, nobody knew what the share price was. But if you're looking to invest and you ever see the market sell off hard and then start to snap back, that's when you want to get in, right? Because the share price goes up and down with everything else. All right, other growth and opportunities. 6 on the team. There's the names there. Some of them, some are fairly new. Jaden is my junior advisor, servicing advisor mostly. So again, if he's sending you emails, those are coming from me, generally I'm like, hey, reach out to everybody about X. So please converse with him as you would me. Obviously, if you reserve the right at any point in time to go, hey, I want to talk to Steve about this. That's exactly why he's here, is to kind of be able to take the workload off of me. So I have time to talk to you about kind of the higher level stuff. So thanks, Jaden, for everything you do for us. Candace is obviously the center of the universe for us, taking care of everything operationally. That's why you're talking to her about paperwork, account issues, scheduling, all of that stuff. Irene and Allison are helping out. Allison's on the morning show with me. You can see it down at the bottom. We run that daily. A lot of good feedback on that, but not a lot of viewers. So, okay. Check it out when you want, when it makes sense to you. I got it. I think it'll grow over time. I produce good stuff, but we'll see. It takes a while to grow these things. I did get an award for top 100 in finance, was featured in an article that's on the front page of the Ankerstar Wealth website, if you see it. The new face up there, David Johnson, welcome aboard. He's my insurance specialist. For a long time, for 7 years now, I've been referring out to different people. I finally found the one person that I communicate and work with the best. He is the CEO of Fortis Life Group. He's former military. He deals almost entirely, he built his business off of helping military folks out. So he's just a superstar player to bring on the team. So again, welcome, David. The next thing in the middle there is the one sheet, the one page, if you will. When I say operational improvements, when I sit down with new clients now, I used to bring a binder and my laptop and all that stuff. I now bring this sheet and say, this is what we're invested in. If this resonates with you, then, consider coming on board. If you're like, no, I just want to invest in the SPY and the BND, it's like, then, well, we're not for you, because we've got all this going on. It has really helped when you think of, talking to new clients and building confidence. I think this is my top confidence builder when I put that in front of the client and say, here's what we're doing. Open kimono, it's right here, and it's working, and the returns have been great, and would love to bring you on board. And that's about the end of the conversation. So it's worked pretty well. I also do some writing. I just switched from writing for the Terra Vista magazine to the Ranch at Brushy Creek. So for those that happen to live over there here locally in Texas, you're going to see my monthly articles start popping up in your magazine. So if you don't read that, pop it open and read it. Okay. Last one I will close with here, because I've talked a little bit long. We're at the half an hour point. I do see there are not any questions. So this is where you would ask questions over there in the Q&A panel. But as far as investing efficiencies and the AWOC, yes, that's the Ankerstar Wealth Operations Center. We'll talk about investing efficiencies first. The financial planning magazine, that is literally the March 2020 issue. And it starts talking about this new thing called direct indexing. I kind of like, I've never heard that before. I'm going to read about it. And then Schwab sent out the verbiage at the bottom. It says it allows advisors to trade weighted baskets of stocks on clients' behalf and gives them the ability to direct their own portfolio of stocks. Designed to mimic the holdings of an index fund, the direct ownership of securities can involve a greater level of tax management for investors. And then to summarize, it says, generally, this has only been available to high net worth. and it's the way to invest. I didn't know it, but this is what I've been doing for the past 7 years. I just never heard it called direct indexing, nor would I call it that, because it implies you're only investing in indexes. But anyhow, so this whole new strategy that's only available to the ultra high net worth, I've been doing for 7 years. I'm going to do it for another, I would do it for 70 if I could. I won't be able to do it for 70, but we'll do it for as long as I can, and then train Ankerstar Wealth to continue to do this. I was wondering why nobody else was doing it, and now I start to see why. Oh, maybe it is catching on. Another thing I put up here is we are experimenting with, to be able to grow and scale, we do need to be a little more model based than I have been in the past. If you're a current client, I build every single one of these portfolios kind of by myself from scratch, starting with my core 20 that I hold, and mold it. Well, there's efficiencies here, and Jaden is working on this, and we're both, trying to use our combined IQ, his is bigger than mine, to try to figure out how to implement this, so we can still retain kind of the core goes into the model, and then the satellite is kind of the individual's, holdings. It makes sense below, like 250K that we would go with this. You get to the higher numbers, and maybe we just keep with what we're doing. But yeah, more to follow on that. We shall see. That schematic you see over to the right, excuse me, the architectural design. This is conceptual right now. Some of you may heard, I mentioned it in the investing brief, where if you're an investor in Ankerstar Wealth, I give you a little more insight. But you do want an operations center. When I decided to come into this business, I worked overseas intentionally. I took a 1-year tour over in Al Udeid in Qatar in the Middle East and helped run the air war over Iraq and Afghanistan. And I did it because I wanted to work in an operations center. And it's always been my dream to have a financial operations center. And that includes having a 24-hour person up, on duty, if you will. There's the crow's nest is what I called it. We'll see how it all plays out, but having one person that's kind of responsible to answer the phone and check email 24/7, obviously that's 3 people, not one person, but sitting in a crew position for that rapid response. I don't know of any financial institution that's doing that. So I want to stand this up on a small scale in a building that, hopefully I'll be able to close on here in about 1.5 years. So it's going to be a while. But if I can do that, that also allows us to this is a 2,500 square foot total facility. That open area there with the crow's nest, the stage, and some tables would be an open venue to be able to bring folks in and talk Secure Act 2.0, Social Security claiming strategies, college savings, talk to people in mass, as well as to hold client events to where you guys can come in and, we'll share a hors d'oeuvre and a beverage and kind of get to know each other better and really just talk strategy, right? And talk investing. So it's going to be a great facility once I have it. Again, 18 months out, but that's where we're going. Another part of this is the family model style. If you're familiar, it's generally been reserved for the 10 million and above crowd. I think I can bring it to the masses if I do it right, which we are the masses. And that if you see the small print at the bottom, having a dedicated CPA, so a tax person and an estate lawyer that work for Ankerstar Wealth, they can be contractors. It doesn't matter who, how the money flows or whatever, but basically where they are full-time assets for us to be able to ask your estate planning and your tax questions. Obviously during tax season is when everybody comes up with their questions, and it can be a little bit tedious, right? Because I have to either refer them out to an actual CPA if it's really hard, or I'm answering stuff that I'm like, at the end of it, I have to say, but talk to your CPA before you act on that. So it'd be nice to have 2 other professionals in those disciplines in-house. So for your wealth management needs, you have one place, one set of people that you're talking to, and don't have to worry about whether they all know about each other or not, that sort of thing. So anyhow, exciting stuff, a little bit down the road. But as you've seen, days drag by, but weeks fly by. So time moves fast. And I think this is going to happen in some form or another in the next 23 months or so. All right. So that's all I've got for that meeting. For the meeting, I do want to thank everybody for attending. I'm seeing some names pop in and out off to the side here. This is, part of a maturing process. I'm trying to build everything out right now as if, we managed $1 billion. And we don't manage $1 billion. But there's going to be a day when we grow to that. So that's what we're looking to do, is put those processes in place. That's why we're having investment advisory board meetings. I'm looking for board of directors, and I'm talking about how we can get operationally efficient when we go from, 50 million to 100 million or 500 million. So, all right. I heard not a question, but a great job. Thank you much. I do appreciate that. Again, I'm only monitoring the Q&A, so I'll hang out for just a few seconds here. And other than that, I'll let you go. Thank you so much for listening in. And again, this will go out in an email to everybody that couldn't or didn't want to attend during dinner, that sort of thing. And again, you're cleared to, it's open source, so you are cleared to send this to anybody you want if you think that they could use our services. So with that, thank you so much, and you guys have a good night. Bye.